This is a download from BFM 89.9, the business station.
Good morning, George. So the U.S. added about 288,000 jobs in May, but the jobless rates still moved up to about 5.5%. What do you make of these numbers, George?
Well, Julian, good morning. Actually, I'm somewhat heartened by the possibility that more potential employees are coming back into the market and looking for jobs. I think that will be good for us longer term. I also do not expect our return back to economic normalcy to be a straight line. I think there'll be ups and downs. I think that's what we're beginning to see. But overall, the trend is favorable, and it is favorable in terms of the absolute number of jobs that are being created, the absolute number of people who are now gainfully employed and have consumer expendable expenditures possible. So I am quite positive. And I'm also watching to see how the market reacts to the possibility, the probability of the beginning of rising interest rates as early as September.
What do you make of the comment that a lot of the jobs that were added were low-quality paying jobs like temp help and waiters and so on? Are you worried about this?
Absolutely, they are lower quality. That is correct. It is a transition that we need to go through. First, we have to have some jobs come back on, and no, they won't be the best. But what we're going to be watching now, you see, what you've brought up is a trend that we are going to be watching as to the quality of jobs that are being created as we go forward. So even the analysis that we're talking about now, the questions that are being asked about the economic improvement that we're seeing are changing and transitioning towards the more normal questions, the more normal possibilities of regular employment. And in particular, as we transition to the better quality jobs of longer term, the higher paying jobs, what we're going to be watching is to see how many come back into the possibilities of being employed, and that will be another positive trend that we expect starting probably in October and November.
Now, the dollar also soared on the back of this news, and views of interest rates rise have now been emboldened. And the thing that would interest me about this is China. How do you think that the interplay of a strong dollar and coupled with China's meteoric rise in stock market, how would you view the interplay of these two markets?
Well, I'm watching very carefully the difference between the U.S. and China in general. What I'm seeing is that they're coming to both parts of this process from a different perspective. Here in the U.S., good economic news is considered bad investment news right now, while in China, good investment news is considered news with favorable economic impact. Our Friday report was another sign the exceptional forces of low inflation, rock-bottom interest rates, and the Federal Reserve support are really going to come to an end. A stronger economy is producing higher inflation, potential for higher interest rates, and is requiring much less help from the Fed. So higher interest rates will attract money to the dollar and boost its value. That will hurt profits, particularly with multinational companies. But as we transition to a more normal and economic and fundamental valuation, I believe that the economic strength will help us become less dependent upon low interest rates. Now, in China, rising stock prices have helped Chinese companies reduce their debt levels and help sell new shares. It also makes it easier for the government to boost budget revenues and push forward their privatization process through sales of stock. And further economic progress will continue to be supported by a monetary stimulus. Meanwhile, back here, the Fed is preparing the U.S. stock market for the beginning of higher interest rates and is consequently withdrawing support for the exceptional market performance, and we're expecting to have a pullback. China wants a strong stock market in order to privatize more companies and promote their IPOs, but you'll see the difference is where we are with regard to economic progress versus our market compared to where they are. The Shanghai Composite rose last week to its highest level in 7 years, while its gross domestic product neared its lowest level since 2009. And consumer discretionary has rallied 75% this year to a record, while actual retail sales grew only 10%, and that's the slowest pace since 2006. So the balance between the two is very, very different. And we wait to see how each country is going to transition out of the current phase.
Have the geopolitical risks changed? I mean, China is making a lot of posturing in this part of the world, and in other parts of the world, we see Iran coming back into the market. How does this affect your portfolio?
Well, Iran definitely affects the price of oil and how the U.S. is going to react, particularly with regard to its relationships with Saudi Arabia and Iran. And Greece is going to be another issue, but that's less of a danger right now. And China is going through a geopolitical process that is going to have to be addressed, but it is much more transitional in nature, and it doesn't have the same urgency and concern that what we're seeing in Ukraine. We're beginning to become a more focused on how the U.S. and right now, from what I understand, we're weighing a harder line on Russia. The administration is now discussing new deterrent strategies to rein the Russian meddling in Europe, and Ukraine is becoming more unsettled again. We could result in an updated version of the Cold War era containment that we went through some time ago. Foreign Secretary Phil Hammond said that there is worrying signs about the increased activity of Russian forces, and the UK could actually consider the pros and cons of taking some U.S. intermediate range of weapons. This is a much more serious threat at this point. No, it is not at the top of the list in terms of what's going to affect the market shorter term, but it is a trend that we've seen with Russia in the past. It is something that we need to monitor, whereas the other geopolitical risks that we're seeing are much more political in nature and have the tendency to be worked out.
And a lot also have been said about Greece. They're making the headlines for the wrong reasons sometimes. What is your view on Greece, and are you afraid of an exit?
Well, Julian, they're going through the normal process of the drama that's necessary in order for all sides to be able to accept compromise. Unfortunately, going through the process, Julian, does make the possibility of an exit more real, more possible, and certainly will be considered more by all sides. So we haven't come to the conclusion that an exit is going to be necessary and absolute, but we're getting to the point where the drama is reaching the phase where a compromise, a further compromise, is going to have to be worked out by all sides. And the question will come as you get closer to the climax. The possibility of an exit can be more real and can be a more real and acceptable response by Greece. So we're going to have. We are concerned. We can still say that this is what is expected, but yes, the concern is rising, which is normal for the drama that has to occur.
Thank you. That was Dodge Dolan, Chairman, Chief Investment Officer at Lander Infused Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.